Hey, what's going on, everybody? Welcome back to Bonafide Investing, where we talk all things high yield investing, options, futures, trading, as well as just investment goals in general. If you're new to the channel, just a little bit of background about what we're doing here in this cash flow life portfolio. About a year and a half, I took about a big chunk of my net worth, about a quarter of it actually, and put it into just a high yield experiment, we'll call it, right? Where it set out to accomplish two goals: pay my bills while also maintaining and paying down my margin over time. So it'll either succeed and have some success, which I'll bring over more capital into this strategy, or it will fail. We'll just go back to the drawing board and figure out something new. But so what I've done, I've tried to construct an all-weather high yield portfolio that, I think accounts for risk first and growth and income second. So please hit like and subscribe if you like what we're doing here at the channel. Nothing we do here is investment advice, not now, not ever. So please do your own due diligence before making any investment decisions. So what we'll do to dive in today, I want to just kind of give a portfolio update. It is the weekend, so it's nice to just take a snapshot of where we currently sit. Just kind of my thoughts around what I'll be doing in 2026, and just some observations I've had just watching some other high yield strategies here on YouTube, some other channels. So with that said, let's kind of dive in. I want to give some updated stats here on the portfolio. So currently we have with the long put options as well as the equity, we're currently sitting at $504,981.50 is the total value. Equity only is $494,554 roughly. And right now, the income from the portfolio is paying $139,858.93 for a 28.3% yield. Accounting for the 4.5% margin I'm borrowing at, it's about a 23.8% net yield. So happy with that. I think 23.8 still gives some room for growth, right? Again, I think there is a strong correlation between high yield and NAV erosion, or high yield and little to no growth. So I want to be mindful of that across the portfolio. The goal here is income over growth. However, I want to have a little bit of growth, and I think I get that across some of these holdings. So those are some updated stats there, using $127,761.83 of margin. I had all 5 of my puts I sold expire worthless yesterday, which was nice. So that brought my margin buffer back up to 63.47%. I really don't ever like seeing my margin fall below 50%. And I don't like using more than 30% of my available margin. So happy with where those numbers are currently sitting. I'm currently using about 25% margin, and that buffer is 13 to 14% above that 50% threshold. So speaking of margin buffer, I was watching some videos, just checking some other channels out, and I'm never here to put anybody's strategy down or think my strategy is superior. I mean, is what we're doing here the best strategy there is? Probably not. Right? There's probably not. I don't think there is a perfect strategy, but it was really interesting to see a lot of the portfolios just not hedged. We had that 5%, roughly 5% sell off in November. Moved down 2 or 3% the past few weeks. So there has been some downside, right, in these markets. And what really blew my mind was watching margin buffers go from 60, 70% down to 10, 20% just from these minor sell-offs. And in my opinion, it's just you're going to blow up your account. I think that there's no way around it. I don't have the bravery, fortitude, whatever you want to call it, to have a 50, 60, 70% yielding portfolio. And then when markets do get choppy, right, just watching that NAV just completely get destroyed. So again, I think that controlling around NAV erosion the best we can, and I talked about it in the last video where I'm dollar cost averaging back in to lessen volatility, buy more shares when the markets go down, as well as really control for the real high yielders in that NAV erosion that they're subject to. So I just found it interesting. I do want to be clear that risk management is one of the keys here, because again, I can't pay my bills if my portfolio blows up, right? If we do get that market crash that I think is looming, I think it's coming. I'm not a fear monger. I like history, I like math, and things are looking very similar in a lot of ways to 29 and 2008. And it doesn't mean that it has to be the exact same, right? But history does rhyme. So I really want to just be mindful of risk. And I think that's one of the key messages with bona fide investing, this cash for life portfolio, is that if we're not hedging, if we're not being mindful of the downside, I think that's where we can get in a lot of trouble. I think that a lot of investors, I did start investing before 2008. I've seen a market crash in 2020, and they're not fun. Nobody likes market crashes. Market corrections aren't fun either, right? Nobody likes losing 10, 20, 30%, but corrections are healthy. And I've said it before, we want to get the excess, the froth, the toxicity out of the system. And that's what corrections do. They keep markets healthy for the long term. So I think 26, we're going to have some volatility ahead of us. I think that, it goes back to that whole passive investing approach. And I think what's happened is we've kind of been lulled into this set it and forget it. And there's nothing wrong with set it and forget it. I think a lot of portfolios, I think most portfolios need some set it and forget it, right? It's just some passive, maybe ETFs. But if you look back on history, from the 1940s to 1970s, we had interest rates rise, inflation go up, and active management was crucial, right, to preserving and growing your wealth. Got to the 1980s to the late 2000 teens, early 2020s, and it flipped, right? We had interest rates falling, we had inflation falling, we had just you can throw a dart at a dartboard full of names of stocks and you probably made money, right? I think that we're going back into everything's cyclical, and I think we're going to go back into a very similar 1940s and 1970s scenario where our debt to GDP is 120, 130% now. I think the government's going to have to inflate that debt away, right? That's how they're going to deleverage, is via inflation. I don't think they have another choice. I don't think they're going to default, right, and crash the global economy that way. But I think active investing is going to be important. I think being mindful of how we're positioned, how we're hedged, and ultimately, being aware of cycles, right? Booms and busts, I think, could become more common. So just some of my thoughts, 2026 onwards, that I think a lot of investors have only known the up direction, right? But usually when markets turn, they turn fast, and usually it's too late. They turn hard, right? There's an old saying that markets eat like birds and crap like bears, right? It's true. It's the escalator on the way up and the elevator on the way down. So just being mindful that all my years in finance as an advisor, there was an old saying that they're called your broker, right? If you have an advisor, they're called your broker because they're a broker than you, and there's a lot of truth to that. I think that many people should fire the brokers. They're only going to tell you to keep investing money, to ignore the noise, ignore, I guess the sell-offs and everything. But what if we get a lost decade? Can you withstand it, right? It's something to think about. Could you withstand your portfolio going nowhere to down for 10 years or longer, right? So it's something you got to ask yourself. Just be mindful of it. I try to be the best I can. I think I said in the last video, when a market crash comes, none of us are getting out of it untouched, right? Some will do better than others, but I'm pretty sure that during crashes, everybody loses to some extent. You might get the few lucky ones that, hedged, they were in the right place at the right time. But market timing's tough. I am personally the world's worst market timer. It's, if the name of this game was to time, not be bad at timing markets, I'd be the best. It's really bad. So I don't try to time markets. I don't want to time markets. I don't think anybody should. But again, I think controlling for risk is a really important thing that we need to do, be mindful of moving forward. So With all that said, happy with where everything currently sits. I'm going to sell some more puts on Monday, just generate more income for the portfolio. I was looking at Nike. Nike got just stepped on Friday after the earnings. I think they're back down to a good valuation, a solid valuation, being below 60. I was looking at selling the put. I do like selling weekly puts on a lot of blue chips, utility companies, things like that to hedge volatility, what have you. And again, the premiums, right, on some more stable companies are lower. But if I go to sell put expiring December 26th, I liked the $57 put. I think the delta, delta 0.2058. So again, the Greeks, just what delta means is what's the probability of those shares being assigned to me. I have found deltas are a little less reliable for weekly options than monthly because you're more subject to that theta decay, that time decay. So 20% probability of being assigned, I think the 23-cent premium, and I'm sure that'll change Monday, either up or down a little bit, but that 23% was still about a 20 to 21% annualized yield, which for, Nike, that's great, on a stable company. But outside of Nike, I'll probably do Coca-Cola again, Bristol Myers. I might even sell a Pfizer put. Pfizer is only about a $24, $25 stock right now, so it doesn't eat up a lot of my equity. Probably do PG&E again, AT&T, Verizon, just a lot of those companies that, again, are very stable, just generate extra income for the portfolio. I mentioned earlier that I'm currently making around $140,000 in income. I didn't include any of my option income. Premiums I usually make between $500 and $2,000 per month on average, sometimes less, sometimes more. So that didn't account for any of that income as well. But let me know your thoughts. If you have any comments, any things you guys are looking at out there. Come 2026, I'll be buying another put on the Qs, another put on SPY, just for extra protection to the downside, especially the higher this market goes. Thursday, Friday, we had some green days. So I do expect still a melt up. I've said this before the meltdown. I was looking at the CNN Fear and Greed Index this morning, and we're currently sitting at slightly neutral. So neutral's kind of a tough place to gauge sentiment, but I don't think bull markets end when there's fear, extreme fear, and I don't even think they end when there's neutral sentiment. So I think once we get really back into that extreme greed, when markets are booming, and good times are here again, I think that's when we're really going to want to be cautious to the downside. So, just some of my thoughts there. Across the portfolio here, no big changes, still the same holdings. We'll keep you updated. Next week, we'll talk more about some puts, maybe some futures, and I hope you got something from today's video. Have a great day.